China's secret gold hoard. The weapon that could topple the dollar? Have you ever wondered what keeps the global financial system from collapsing under the weight of its own debt? For decades, the answer has been the United States dollar. But what if the foundations of that system are cracking? What if a quiet, calculated war is being waged not with tariffs and trade disputes, but with tons of physical gold being moved in the deep vaults of nations looking to architect a new world order? A silent coup is underway. And at its heart lies a global power shift, with China holding the reins, aiming to displace the dollar and reset the very definition of money. The prevailing economic condition is one of fragile, interconnected debt. The United States, the issuer of the world's primary reserve currency, is also the world's largest debtor, with a national debt spiraling past $37 trillion. This isn't merely a domestic issue, it's a global one. Nations around the world hold their wealth in United States Treasury bonds, effectively lending to Washington and anchoring their own financial stability to the dollar. For decades, this arrangement was mutually beneficial, providing the world with a liquid, stable asset and the United States with the ability to finance its deficits at a low cost. A dynamic often referred to as an exorbitant privilege. However, this privilege has been strained. The dollar's stability is increasingly perceived as a vulnerability by other nations. The weaponization of the dollar through sanctions and asset freezes has sent a chilling message across the globe. When nearly $300 billion of Russia's foreign exchange reserves were frozen, it served as a stark reminder that assets held in the dominant currency are subject to the political will of its issuer. This has created a profound sense of unease, particularly among nations that find themselves at odds with Western foreign policy, prompting a desperate search for a financial sanctuary beyond the reach of Washington. This search has led directly to the world's oldest and most trusted form of money, gold. Central banks are now accumulating physical gold at a pace not seen in over half a century. These institutions, which manage their nation's wealth, are fundamentally reshaping their reserve strategies. This is not a speculative frenzy, it is a deliberate, strategic pivot away from fiat currencies and paper assets that can be devalued or seized. The unprecedented scale of this institutional buying spree signals deep-seated concerns about the long-term viability of the current dollar-centric financial framework and a collective move toward tangible assets as a bedrock of national sovereignty. The primary catalyst in this unfolding drama is China. Beijing has been executing a multi-decade strategy to reduce its reliance on the United States dollar and position itself at the center of a new monetary order. This strategy is multifaceted, operating across production, trade, and reserve accumulation. China is not only the world's largest consumer of gold but also its leading producer, giving it immense influence over the physical supply chain. This dominance allows Beijing to absorb its vast domestic production without distorting international markets, quietly building its national treasury away from the prying eyes of global financial institutions. Further solidifying its influence, China established the Shanghai Gold Exchange, or SGE. This institution represents a direct challenge to the Western-dominated price discovery mechanisms of London and New York. Unlike the London Bullion Market Association, LBMA, and the COMEX, which primarily trade in paper contracts and derivatives, the SGE emphasizes the trading of physical gold with mandatory delivery options. This focus on tangible metal has made Shanghai the world's largest physical gold exchange, with trading volumes that now rival its Western counterparts and increasingly influence global prices. The SGE's Shanghai Gold benchmark, priced in Chinese yuan, is a crucial tool in the mission to internationalize China's currency. By providing a robust, physically backed alternative for gold trading, China is slowly chipping away at the dollar's dominance in commodity pricing. This move has found a receptive audience among other nations eager to bypass the dollar. A consistent premium for gold on the SGE over London prices indicates a powerful and sustained demand for physical metal in the East. A gravitational pull that is steadily shifting the center of the gold market away from the West. This strategy extends beyond gold. China has also methodically secured its position as the dominant force in the world of rare earth materials, controlling approximately 70% of the world's mining and nearly 90% of its processing. These elements are the indispensable building blocks of modern technology, vital for everything from microprocessors and consumer electronics to advanced defense systems like jet engines and radar. This strategic control over a critical resource gives Beijing immense leverage in any geopolitical or economic conflict. A powerful card to play in its long-term rivalry with the United States. China is not acting alone. It is the leading force within the BRICS bloc of nations: Brazil, Russia, India, China, and South Africa, which has recently expanded to include new members like Saudi Arabia, the UAE, and Iran. This coalition of emerging economies represents a significant portion of the global population and GDP. United by a shared desire to create a multipolar world, the BRICS nations are actively collaborating to build an alternative financial architecture. They are settling more bilateral trade in their local currencies and developing new payment systems to circumvent the dollar-based SWIFT system. Gold is the silent, glittering thread that ties the BRICS strategy together. The central banks of China, Russia, and India are consistently among the world's top gold buyers. Their collective accumulation of physical bullion is staggering and points toward a coordinated effort to build a foundation of hard assets that could underpin a future challenge to the dollar. Discussions within the bloc about creating a new reserve currency, potentially backed by a basket of commodities including gold, are no longer theoretical. Such a currency would offer member nations a way to trade and store wealth outside the direct influence of American monetary policy. A critical element of this global gold gambit is the Great Repatriation. For decades, it was common practice for central banks to store a portion of their gold reserves in the secure vaults of New York and London. This was a legacy of the Bretton Woods system, a gesture of trust in the stability of the Western financial system. That trust has eroded. In recent years, a growing number of nations have been demanding the return of their physical gold, choosing to store it within their own borders. This trend reflects a profound shift in geopolitical alignment and a growing concern about the accessibility of national assets during a crisis. The underlying logic is simple and primal: if you don't hold it, you don't own it. The weaponization of financial systems has underscored the vulnerability of assets held abroad. By bringing their gold home, countries are reclaiming full sovereignty over their ultimate store of value. This movement is a quiet vote of no confidence in the current custodians of the global financial system and a clear signal that nations are preparing for a world where physical possession of hard assets is paramount. It is a fundamental realignment of wealth and power, moving tangible assets away from the West and into the hands of rising powers in the East. The critical event, the tipping point where this gradual shift becomes an irreversible avalanche, may not be a single dramatic announcement but a confluence of undeniable facts. One potential scenario involves China's official gold reserves. It is widely speculated among market analysts that China's publicly reported holdings of around 2.300 tons are a significant understatement of its true position. Estimates suggest the actual figure, including gold held by various state-owned entities, could be more than double the official number, potentially making China the world's second-largest official holder after the United States. Imagine the geopolitical shockwave if Beijing were to suddenly revalue its reserves and reveal holdings of 5,000 tons or more. Such a move would instantly alter the global balance of monetary power. It would lend immense credibility to the yuan and provide a substantial foundation for any gold-backed currency initiative launched by the BRICS alliance. This revelation would not be an act of aggression in a traditional sense, but a strategic move on the global financial chessboard, declaring that a new power has accumulated the assets to challenge the incumbent. It would be a checkmate delivered in silence. Another potential tipping point could be the official launch of a functional and widely adopted BRICS trade settlement currency. While still in development, the framework for such a system is actively being built. If the expanded BRICS bloc, which now includes major oil producers like Saudi Arabia and the UAE, were to begin pricing and settling energy contracts in this new currency, it would strike at the very heart of the petrodollar system that has underpinned the dollar's global dominance for 50 years. This would mark the first credible, large-scale challenge to the dollar's role in global trade. The consequences of such a shift would be profound and immediate. Demand for the United States dollar would fall dramatically as nations would no longer need to acquire it for international trade or to hold in their reserves. A decline in demand would lead to a significant devaluation of the currency. For the United States, this would mean the end of its exorbitant privilege. The cost of financing its massive national debt would skyrocket as foreign investors would demand higher interest rates to compensate for the currency risk, placing immense strain on the federal budget. This currency devaluation would manifest as severe inflation within the United States. The cost of imported goods, from electronics to clothing to food, would rise sharply, eroding the purchasing power of every American household. The impact would ripple through financial markets, causing a potential decline in the value of United States stocks and bonds as global capital is reallocated away from American assets. The transition could be volatile and disruptive, potentially destabilizing the entire global financial system as the world adjusts to a new monetary landscape. In this new landscape, the world would likely become more financially multipolar. Instead of a single dominant reserve currency, we might see the emergence of several currency blocks centered around the dollar, the euro, and a yuan-led BRICS currency. Gold would likely play a crucial role as a neutral reserve asset, a trusted arbiter of value used to settle imbalances between these competing blocks. Nations holding significant gold reserves would find themselves in a position of enhanced strength and stability, their wealth insulated from the turmoil of depreciating fiat currencies. For countries that have spent decades accumulating physical gold, this new reality would represent a historic victory. Their foresight would be rewarded with financial sovereignty and a more prominent role on the world stage. For the average citizen in these nations, a currency with the backing of a tangible asset could offer protection against the kind of monetary debasement that has plagued fiat systems. It promises a return to a system where the value of money is anchored not by government decree, but by a finite and universally respected resource. One of the most significant and painful consequences of this transition would be the fate of existing sovereign debt. A core argument for a return to a gold-backed system is that it imposes discipline on governments, preventing them from printing money to finance endless deficits. However, for a country to credibly back its currency with gold, its existing mountain of debt must be dealt with. The sheer volume of debt in the current system, particularly in the United States, makes a simple transition impossible. The debt is too large to be repaid with sound money. Therefore, before a new, gold-anchored system could be born, the old system's debts would likely need to be wiped away through a period of intense hyperinflation. This process would effectively render existing debt worthless, allowing nations to start with a clean balance sheet. It would be a brutal and chaotic monetary reset, destroying the savings of those holding wealth in the depreciating fiat currency and its associated bonds. This is the harsh reality that underpins the move toward a new system. The creation of a new, stable foundation requires the demolition of the old, debt-ridden structure. The ultimate lesson from this quiet global gold war is a timeless one: the cyclical nature of power and money. For centuries, the center of global economic power has shifted from one empire to the next. And with each shift, the dominant global currency has changed. The Dutch guilder, the French franc, and the British pound all had their time as the world's reserve currency before being supplanted. The current era of the United States dollar's dominance, which began after the Second World War with the Bretton Woods Agreement, is not an exception to this historical pattern. The Bretton Woods system initially pegged the dollar to gold, making it the bedrock of global finance. However, in 1971, the United States unilaterally severed the dollar's link to gold, transforming the global monetary system into a purely fiat experiment. This move unshackled governments from the discipline of a hard asset, enabling the massive expansion of debt and credit that has defined the global economy for the past 5 decades. We are now witnessing the inevitable consequences of that decision, as faith in an unanchored fiat system begins to wane. What China and its allies in the BRICS nations are doing is not revolutionary in a historical context, it is a classic maneuver. They are responding to the perceived instability and excesses of the current system by returning to the oldest and most enduring form of money. Gold is the ultimate financial insurance policy because it is no one's liability. Its value is not dependent on the creditworthiness of any government or financial institution. It is a tangible asset with a history of preserving wealth through every imaginable crisis. From economic depressions to world wars. The enduring principle we can draw from this is that in periods of great uncertainty and geopolitical transition, value inevitably flows from the intangible to the tangible. Power gravitates towards those who control real assets, be it productive capacity, vital natural resources, or universally accepted stores of value like gold. The complex financial instruments and layers of debt that characterize the modern economy can create immense wealth in times of stability. But they are fragile in the face of a systemic crisis. This unfolding narrative is also a powerful call for a return to the principles of sound money. A sound monetary system is one that serves as a stable and reliable store of value, protecting the savings of individuals from the corrosive effects of inflation. It is a system that imposes fiscal discipline on governments and fosters long-term economic stability. The current fiat system, with its endless cycles of boom and bust driven by credit expansion, has arguably failed to meet this standard. The push for a system that incorporates gold is, at its core, a demand for redeemability, the right of the public to convert their currency into a real, tangible asset. This feature creates accountability. If citizens lose faith in the policies of their government or central bank, they can protect their wealth by pulling gold out of the system. This acts as a powerful check on monetary mismanagement and returns a measure of power to the hands of the people. It is a mechanism for enforcing fiscal responsibility from the ground up. As we look to the future, the trend of de-dollarization and the remonetization of gold appears irreversible. The geopolitical tensions and the sheer scale of global debt have set in motion forces that are now difficult to contain. The world is moving away from a unipolar financial system centered on the United States and toward a more fragmented, multipolar order. In such a world, gold is poised to resume its historic role as a neutral, stabilizing anchor in the international monetary system. The ultimate outcome of this quiet war is not yet certain. The transition could be orderly and managed, or it could be sudden and chaotic. But the direction of travel is becoming increasingly clear. We are witnessing the slow-motion unwinding of a 50-year-old financial experiment and the beginnings of a return to a system where hard assets, not promises, form the foundation of global wealth. The nations and individuals who understand this historic shift and position themselves accordingly will be the ones who not only survive the transition but thrive in the new financial landscape that emerges. This is not merely a story about currency exchange rates or central bank balance sheets. It is a story about the future of money itself and the rebalancing of global power. The vast accumulation of gold in the East is more than just a financial strategy. It is a declaration of economic independence and a foundational step in building a new world order. The quiet war is unfolding, and the fate of the global economy hangs in the balance. The golden age of the dollar may be coming to an end, making way for a future where value is once again defined by something real,